But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes, but someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, you know, the 60-40 mantra we've been talking about for so long, we think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20.
Andy Schectman has issued a warning that the world may be on the brink of a significant structural shift in gold and silver due to the increasing tension in the global precious metals market. This has prompted renewed concern among analysts. Recent data indicates that substantial quantities of physical silver are being transferred from exchange warehouses to secondary storage facilities throughout the United States, a concerted endeavor to satisfy the increasing industrial demand in the face of a shortage of supplies. Simultaneously, China's state-owned enterprises have been utilizing the reduced prices to their advantage by purchasing silver from global markets in order to increase their national reserves. Schectman underscores that these actions point to a more profound global divide. The West continues to depend on financial engineering and paper derivatives to sustain an illusion of stability, while the East accumulates real assets. The strain is further exacerbated by reports of a 150-ton silver lease between the Shanghai Metals Market and the London Metals Exchange, LME. The transaction reveals the increasing desperation of Western institutions that are struggling to source deliverable metal, as it was conducted at unusually high lease rates. Schectman interprets this as a signal that the market's paper structure is on the brink of collapse, necessitating bullion institutions to lease physical metal at exorbitant prices in order to satisfy short-term obligations. This pattern of aggressive paper selling to drive prices lower and then discreetly accumulating physical metal at those depressed levels has become a defining characteristic of a system under duress. One who is becoming increasingly unable to reconcile the disparity between synthetic supply and real-world scarcity. Schectman contends that the fundamental issue is a crisis of confidence that affects Western financial institutions. He identifies the deterioration of trust in the dollar, the increasing skepticism toward regulatory bodies such as the CFTC, and the lack of transparent data as factors that are accelerating the flight to tangible assets. The CFTC's failure to provide critical positioning reports has resulted in a significant reduction in transparency in the gold and silver futures markets, which has enabled large participants to operate without oversight. Although the volatility and media narratives suggest overbought conditions, Schectman maintains that this is not a speculative bubble. Rather, it is the initial phase of a global monetary realignment, in which gold and silver are progressively being revalued against weakening fiat currencies. We are now presenting the excerpts from Andy's interview. Prior to proceeding, please be sure to subscribe to our channel and activate notifications in order to receive timely updates. I appreciate your assistance and hope you enjoy the video.
We're in the thinnest part of the trading cycle when New York is fast asleep. Someone or some entity or a coordinated effort dumped a massive wave of futures contract onto the market. Again, when New York was fast asleep, this drove silver under $50. It knocked gold down $100, but then something interesting happened. I mean, this was shock and awe, Michelle. This is a drive-by shooting, right? Any trader that would be stupid enough to dump that level of futures onto the market at the thinnest trading segment of the day, when there's virtually no liquidity, would be fired and shot, and probably not in that order. And it was specifically done for effect. But what was interesting is that we saw players come in almost immediately right after this happened and push the price right back up. Now, is that physical buying? Is it knocking down the paper price and coming in and buying the physical to cover the shorts? Maybe. We don't know who it is. We have an idea. Watching or reading Michael Lynch gives us a good idea, a little bit of a snapshot. He comes out and says straight out that this was an engineered crushing by the paper shorts. They're behind it, behind the scenes. But someone came in and snapped up at a record pace. He thinks it's Bank of America and Morgan Stanley. The interesting part about that is it was a month ago where the chief investment officer for Morgan Stanley came out and said, yeah, the 60-40 mantra we've been talking about for so long, we think we should sell 20% of the bonds, 60-40 being the Wall Street steadfast way of investing, 60% stock, 40% bond. He says, no, let's do 60-20-20, 20% bond, 20% gold. Well, Michael believes that there are footprints of Morgan Stanley and Bank of America, whose high price analyst, Michael Hartnett, whose newsletter I believe is at least $10,000 a year, only speaking to the institutional traders, came out and said, no, it should be 25, 25, 25, 25, 25% stock, 25% bond, 25% short-term treasury, 25% gold. Bank of America last week raised their target on silver to over $66 or $67 for next year, with an interim price, medium price between now and then, or an average price of somewhere around 57. He goes on to talk about that since October 17th, 6,000 new immediate delivery contracts were written, which is all but a record for this late stage of the delivery cycle. And he goes on to say, if the pace continues, it could be one of the biggest delivery months ever on record, challenging the February and March deliveries. So in other words, the market got bombed by paper in the middle of the night when no one is trading and New York is asleep, which provides all the liquidity. But yet someone came in and gobbled a whole bunch up. And at the same time, we saw 11,000 paper long contracts closed out. So this is a very unusual drive-by shooting for effect type of sell-off, yet some of the fundamentals that are cited by the mainstream are true. It's a half truth. Yeah, those things are true, and the markets can stay overbought for a long period of time. But to ignore how the sell-off occurred and just simply say this is profit taking is ridiculous. It's just not good reporting, is what it is, because any normal trader would have spread that out during the most liquid time of the day in New York trading over hours or even days to maximize that level of return, not dump it on for effect. And that's exactly what happened. And I think that is something that should be taken into consideration as we continue to talk about what's going on.
Well, for sure. But I think we need to break down what you said there. So what did you mean by in the middle of the night there was a paper dump? Break that down, explain in as much non-technical detail what exactly that would mean and how that would drive the prices down.
Well, it would have been, in the access market, could have been in between. It was probably in between the closing of Asia and the opening of London, somewhere in that period of time where the main price setting is done in New York. The traders who would provide the liquidity, the big banks, would be found in New York City. And if you are going to execute a trade, you don't, if you wanted to sell $25 million worth of a stock in a thinly traded market, you don't just dump it onto the market to cascade the price and get the worst settlement. You would do it over time, slowly, maybe through multiple entities, not trying to spook the market, but by dumping it into a market that is thinly traded, meaning not in New York and not even when London is fully operational or right as China is closing. You're talking very few players are providing liquidity. It is going to provide the worst possible settlement you could possibly get. It's done for effect. It would not be the way that any trader with half a brain cell would ever try to maximize return for their client or for their own position. and it is specifically done to drive down the paper price.
One of the most significant shifts in modern financial history is currently being discreetly experienced by global markets, a transition from paper assets to tangible repositories of value. Foreign investors have gradually decreased their exposure to U.S. Treasuries over the past decade, decreasing their holdings from nearly half of all outstanding debt in 2012 to a mere 31% today. The increasing unease regarding the ballooning U.S. deficit, record federal debt, and an economy that is becoming more reliant on money printing to maintain its stability is reflected in this trend. Concurrently, the finance system is experiencing a reduction in liquidity. Short-term funding markets are once again exhibiting cracks, and regional institutions are under pressure. The system's fragility is underscored by the fact that mortgage-backed securities are being pledged in repo markets rather than treasuries, a phenomenon that has not occurred on a large scale since the 2008 crisis. Andy Schectman maintains that these advancements are not coincidental. Rather, they are interconnected. He contends that the increasing skepticism toward the dollar and Western financial institutions is fostering a global migration toward gold, not as a speculative asset, but as a protective measure against systemic risk. Andy observes that the recent volatility in the gold and silver markets, which has included significant price drops, may be the result of deliberate efforts by major players to suppress investor sentiment while they discreetly accumulate physical metal. He characterizes it as controlled desperation, a last-ditch effort to preserve the illusion of market stability as physical supplies continue to constrict and global demand accelerates.
Michael Lynch says that Bank of America and Morgan Stanley, which had been dormant for a long time, are actually net sellers, flipped from selling, and he believes that they are two of the largest purchasers that came in and snapped this up. Now, a lot of this is he has a way of figuring it out, and I think everyone should check him out, read him on his Substack and on X. He does a great job of analyzing the inflows and the outflows and who's buying and who's selling. But the bottom line is, I think what we take away from this is that there were some big players who scooped up. And is it scooping up physical to cover short positions below 50, below moving averages, or at least below trend lines? And I think that's actually possible, because what we see is the buying of, in the last 3 days, by Morgan Stanley, 196,200 ounces, by his estimation, in the last 3 days of gold. So, when you talk about knocking the paper price down to create the lowest or worst possible settlement to drive the price down, and then buyers coming in to scoop up, I mean, that just reeks of coordination, of suppression, of a ulterior motive, rather than doing it the way any normal person would do, and that would be to slowly sell your position to maximize the return instead of the antithesis, what we saw.
Again, a lot to dissect there, Andy, but if they bought it up, wouldn't we see, a rally, or did that just prevent it from falling?
No, we did see a rally. I mean, we saw it turn around tremendously. If you look at the chart, they knocked the hell out of silver. It was down considerably, and then actually within a half hour was in the green, went up, and gold pared back roughly half of its losses. So there was some of that involved, but again, the amount of contracts that were dumped to push the price this low also would trigger other automated sell signals, that a lot of these funds will be automated by black box trading systems, where levels are breached, they immediately trigger sell stops, and that's what would have happened. So a lot of people were sold out of their positions while they slept at night, and those that were knowing what was coming were able to come in and gobble things up on the cheap. Not all of it, but enough to certainly benefit some of the players who knew what was coming. What is it? And again, some of that would go in line with what we are being told, the conventional wisdom. Look, what matters? Supply is still tight. Central banks are still buying. Nothing's changed. Debt, wars, money printing, it is all continuing. And maybe when you take a look at what's happening around a government shutdown, being criticized by the UK for the problem with our banks and the fragility within it, problems again that are starting to creep up in the repo market. Gold's getting noticed by Reuters and Bloomberg, and all of this commentary shedding a light on gold. At the same time, things are a mess here in the United States to a degree that I think perhaps maybe the players that have ulterior motives, whether that be to continue to accumulate or whatever their reasons were, I guess to me, it's we're not going to really know, because all I can tell you is that it's as illogical as wearing a parka in Death Valley in July to dump that kind of metal onto the market at the most inopportune time. And it was done specifically, I think, to create an effect. Yet at the same time, what is the motive? What is the motivation? Is it the US government coming in and really not wanting the light to be shown upon gold at that level because they're still trying to accumulate it, or other entities, other banks that are getting margin called, looking at severe stress in the London market, trying to drive the paper price down to protect themselves, to cover their positions? We could pick a million reasons why it's happening, but to me, the why is less relevant, as is the how it happened. And in any of these instances, if any of these players wanted to do things legitimately, it wouldn't have been done the way that it was done. It was done to rattle the market. And maybe it was to, the retail investor. Over the last several weeks, I was just in Aruba for 8 days. I never saw the ocean for more than 30 minutes. We were working nonstop. Business has been accelerating tremendously. It's starting to catch the eye of the mainstream and of the public. Maybe that's not what they wanted to see. This was a flush. Now, at the same time, look, a flush, you could argue, would have been inevitable after 9 weeks of going straight up and moving in a way that freaked a lot of people out. Never seen anything like this. But to your point, gold is no longer overbought as it was since late August, which is a good sign. It hasn't quite yet reached oversold, but what's interesting, silver has also confirmed an uptrend. Both of them have been an uptrend of a 200-day moving average, both of them continuing up. We haven't seen lower lows yet, but what we see with silver now is that it has already nearly reached its oversold levels, and that's something very bullish, a technical indicator that should say that maybe the flush in silver has stopped. And in the short term, we should expect it to rebound. We could see a little more weakness in gold, because even though both are no longer overbought, silver technically is no longer oversold. Gold, not quite there yet. So from a technical standpoint, sure, there is some merit in what the mainstream says. The application of how it came about is flawed. And to not bring that up is only telling half a story.
The global financial undercurrents are now unmistakable, indicating a seismic revaluation of real assets. This is due to the fact that central banks are continuing to increase their gold reserves, and nations such as China, Russia, and others within the BRICS alliance are accelerating efforts to bypass dollar-based settlement systems. A potent yet quiet transformation is taking place beneath the surface. Western markets are exhibiting fissures that cannot be disregarded, as they are becoming more reliant on leverage and paper contracts to hold prices down. Gold will not merely increase in price when the equilibrium is ultimately disrupted. It will be redefined with a specific purpose in mind. In this developing scenario, gold is well positioned to reclaim its status as the foundation of global trust, a standard of value in an era in which confidence in fiat money is rapidly diminishing rather than as a speculative asset. In a manner that initiates a historic surge, silver may also follow with unprecedented force, bridging its industrial and monetary identity. The momentum that is propelling this transformation is discreetly but relentlessly accumulating. Currently, the sole uncertainty is not whether or not the reset will occur, but rather the extent to which the moment of reckoning will be sudden and disruptive, when global confidence in paper wealth ultimately collapses. Please share your opinions on Andy's analysis in the remarks section below. If you find this video to be informative, please consider supporting our channel and activating notifications to remain informed about our most recent content. I appreciate your attention.